Joining us now at Post 9 is Goldman Sachs senior strategist on the U.S. portfolio strategy team, the portfolio strategy macro team. Apologies, Ben Snider. Thank you for being here. So we were just chatting about how you put together this basically summary insight analysis of how people trade during the quarters, and you have your latest one out on the second quarter, 13Fs, which just recently came out. I found it interesting in this report that you say that the Goldman hedge fund VIP list of most popular long positions has actually returned 19%. That's outperforming the equal weight S&P as well as a basket of most concentrated shorts. What were the key drivers of alpha that you saw kind of going through this analysis?
Yeah, it's been a good year so far for the average hedge fund. Not only are the long positions outperforming, but the short positions are underperforming. So we think of hedge funds as generating long and short alpha, and they're doing that so far this year. When we look at the key, I think there's really two things to focus on. The first is that, of course, the mega caps, as we all know, have continued to outperform this year, and 6 of those 7 mega cap tech stocks are the top 6 stocks in terms of popularity across hedge funds. So that's one part of it. The other is that hedge funds have really added conviction to their positions. In fact, if you look across the average hedge fund right now, 70% of their portfolio is in their top 10 stocks. So they're getting the stocks right, and they're really putting conviction behind those calls.
But crowding has gone down. Net leverage has gone down. I'm curious how, at this juncture, how hedge funds are kind of thinking about those big tech names. Because for a long time, there was a lot of overcrowding into those names. And you can't blame them because that was what was working. And that was what was comprising so much of the index that they were kind of adjudicated against. And so at this point, as you see the rotation and the broadening of the market, are you also seeing more conviction in names outside of those Mag 6 names, which I know you identify as basically the Mag 7 ex Tesla?
Right. Yeah. So hedge funds definitely have conviction in their own portfolios. But to your point, they've become increasingly concerned with the degree of crowding across hedge fund portfolios. And not just that, but also the really extreme level of gross leverage of assets that both on the long and short side. And so one thing we've seen over the last couple quarters is hedge funds on the margin moving a little bit away from big tech. Still, again, very popular positions, but less popular than they were a couple quarters ago. And I think that's part of the reason that hedge fund returns were so resilient earlier this month and last month, even with that market volatility that we saw.
Were you surprised not to see any kind of bigger issues come out of the yen carry trade unwind, however you want to frame it, the issues of July?
It's funny. I talk to a lot of investors who say, look at what happened. Aren't you worried about that going forward? To me, it's extremely reassuring, right? We had the VIX rise above 65. We had an extremely sharp drawdown for the S&P 500, and yet the market's basically back to its high. Hedge fund and mutual fund returns have been pretty solid. That's confidence inspiring.
Very quickly, can I ask, did I read this wrong? 9% year-to-date gain is the average for hedge funds?
Correct.
And you're framing that as good? That's not great in this market, is it?
I think that's pretty good. You know, I think often investors like to compare a hedge fund return with something like the S&P 500.
Sure.
But for the average person putting money into a hedge fund, you're not trying to generate the S&P return. You're trying to generate a pretty steady, uncorrelated return. You can think of it more like a bond, really, than a stock. And from that perspective, 9% year-to-date is pretty good.
An expensive bond.
Or 5% guaranteed in a bond with zero risk. I don't know. 9% in this market seems pretty average.
They risk adjust, Wilf. They risk adjust everything.
Paying
that's what they
2
like
and
to
20
say.
for that?
That's the marketing. It's worked pretty well.
Yeah.
Worked pretty well.
Well, we appreciate your insights, Ben. Thanks for being here.
Thank you.